I was literally in Seoul 2 months ago, and while I was there enjoying my trip, thousands of South Korean investors were sitting at home watching their portfolios collapse. So, what exactly happened? And you may have heard online like SK Hynix, Samsung Single Stock ETF. This video is the story of what exactly happened and why the lessons here aren't just for Koreans. They are for anyone who invests, including us in Singapore. So before I get into what happened, quick background on SK Hynix because I know everyone's familiar with Samsung but may not have heard of this name before. SK Hynix is South Korea's second largest semiconductor company, one of the world's biggest memories chip makers. The chips inside your phone, your laptop, and increasingly inside AI servers. In the AI boom, SK Hynix became really critically important. The AI system powering ChatGPT, Google's AI, and almost every AI product that you've heard of, they are running on specialized chips called high bandwidth memory, or HBM in short. SK Hynix makes those chips. And Nvidia, the company that all of you are really familiar with, is SK Hynix's single biggest customer. So interestingly, just this week alone, SK Hynix and Samsung signed a $950 billion partnership with US big tech, including Nvidia. SK Hynix alone committed $750 billion in memory chip supply, and long-term deals have been locked through 2030. Wow. And just a few weeks back, SK Hynix also listed its shares on the Nasdaq. So Singaporean investors like you and I can now buy direct into SK Hynix in the US market. And just for your information, Barclays has also set a price target of $330 with a 70% upside from current levels. So let's be very clear, right? SK Hynix is a real, legitimate, critically important company, and the AI demand for their chips is real, right? Business fundamentals, if you look at it online, it is strong. But why? Why retail investors who bet on SK Hynix and Samsung leverage products still lost over 70%? So I think you can hear from all this is like, the company was doing right, isn't it? But somehow the way the retail investors were doing was wrong. So what exactly happened and why did all of this took place, and how can we prevent it as Singaporeans who have access to these stocks right now? I think we cannot deny that from 2025 into 2026, AI was the hottest story in global markets. So Samsung and SK Hynix was really riding that wave really hard. And on May just this year, South Korea launched the single stock leverage ETFs tied directly to Samsung and SK Hynix. These products are designed to give you twice the movement of the daily stock prices. So if Samsung is up 5% today, your ETF will gain 10%. It sounds really great, right, on the way up. So what happened was retail investors rushed in. A net 14 trillion Korean won, approximately 9.7 billion US dollars, poured in within weeks of the launch. And here's the part that really struck me. When I was reading the news, I realized that these weren't just the young people chasing hype. There were many investors in the 40s and 50s who considered themselves experienced investors. They have seen the AI rally and they wanted in amplified returns. This was really what drawn them in. But then the rally reversed its way back and really hard reverse. SK Hynix leveraged ETF fell approximately 70% from its peak. Guys, 70%, no joke. On one day alone, the KOS PI index dropped nearly 9% and 7 market-wide circuit breakers were triggered in 2026, with more than half of all such events since the mechanism was introduced. We have forced liquidations when brokers automatically will sell your position because you cannot cover your losses. And that was a total of 2.3 trillion won, approximately USD $1.6 billion in just roughly 2.5 months. So on investment forums, people were panicking and very, very angry. They were like saying and posting, please give me my money back. So guys, what exactly went wrong? Because clearly this isn't just bad luck, isn't it? So I would say that there are three things combined to make this really particularly devastating. While the company was doing right, okay, one reason was because leverage amplifies in both directions. A 2 times leverage ETF means 2 times the gain, but you must remember that it also means 2 times the losses. And because this ETF resets daily in a volatile, declining market, the losses compound in a way that is so mathematically brutal. You can lose more than twice what the stock itself loses over time. And I think a lot of people didn't fully grasp that. They were just all thinking about the gains. And let's talk about reason number 2. These are single stock ETF. And we talk about single stock, it means concentration, right? So when sentiments shifted, when doubts creep in about whether AI infrastructure spending would keep growing at that pace, both stocks tumbled together. And there was nothing to soften the blow, right? Because single stock right? Single stock ETF. Number 3, the scariest, herd behavior, also known as FOMO. You see other people join, you also want to join. You saw the rally go up, let's go. It feels like validation. Asset in the 25 largest leveraged Korean ETFs doubled from 15% to 30% of Korea's entire ETF market in 6 months. The kind of rapid concentration is a warning sign, but when everyone around you is like making money, I guess these people felt like it's really hard to step back and not join in. And I know what some of you are already thinking. Okay, so they shouldn't have used leverage products, they shouldn't have FOMO, but what could they have done differently if you as a user, as an investor, genuinely believe in the company like SK Hynix and Samsung? I think that's a fair question to ask, and in my opinion, I would look at this in 3 different approaches that would have given them exposure to this AI chip story without that claustrophobic downside. Okay, firstly, I would buy the actual stock directly, not a leveraged version, not a 2 times product. Just go straight into SK Hynix or Samsung shares. Okay, yes, if they make a loss, the sales tumbles, you would have a sell-off and you would be hurt. But a 30 to 40% drawdown is survivable. But if you're talking about 70% loss from leverage, that's a different conversation entirely. So guys, now SK Hynix is listed on Nasdaq. Singaporean investors like you and I can buy it directly without going through the Korean stock exchange market. And number 2, what I would do differently is to invest through a broad semiconductor or tech ETF, something that holds Nvidia, TSMC, Samsung, SK Hynix, and dozens of others. Yes, your upside is diluted, but if one company collapses, the other can kind of like cushion the fall. So as you all know, diversification isn't like exciting, it's boring, right? But it's somehow the reason that long-term investors can survive most market crashes. And number 3, position sizing. Even if someone wanted that leverage product, we should always think about how much of your portfolio you would like to put in a high-risk bet that is considered speculative position. 5% or putting 40 to 50%, right? If you put yourself here, it's like financial destruction, right? Because you are using too much of your money in this high-risk product. Conclusion, the lesson isn't don't even invest in AI or semicon. Okay, the sector is real. The growth is real. The $950 billion deal also proves that demand is real. The lesson is how much you invest matters as much as what you invest in. The right exposure, the right size through the right vehicle at the right time. So now I think a lot of you are thinking, why am I watching this, That Financial Girl, and why are we covering this on a Singapore Finance YouTube channel? Because I think these ingredients exist here in Singapore too. It's a hot theme, right? Products making it easy to bet big, retail investors piling in late, leverage amplifying the downside. So 4 things I want all of you to take away really is that first you must understand what you are buying in, right? I think you can follow a lot of finance YouTubers and educators who talk about broad index funds and long-term diversified investing. Those products are okay, they are fundamentally different, really different, okay, from those sort of like 2 times single stock leverage ETF. I think don't let the word ETF make you think they actually fall into the same category, because they are clearly not. And the second takeaway would be concentration risk. One sector, one company, one narrative. That's a bet, a gamble. Okay, not betting on portfolio. Well, bets sometimes pay off, but with leverage, when they don't, the downside is crazy, and I don't think we want to be in that position. And number 3, leverage, right? Leverage is designed actually for most professional traders. It's not supposed to be used as a shortcut for retail investors. So we have to be really mindful of that. And fourth, I would say, is late money in a hot trade is the most dangerous money. By the time something you see pops up on the forum, on every group chat, every headline, just bear in mind that the easy gains are already made and you could be last in the herd. And before you think this is just a South Korea problem, this is the South Korean name, let me tell you, this hits closer to home. As I said earlier, SK Hynix just listed on the Nasdaq on July 10. So Singapore retail investors can now buy it directly. And in the US itself, please be really careful, because there are already over 50 single stock leverage ETFs tracking Tesla, Nvidia, Meta, Apple, blah blah blah. And they are also launching SK Hynix leverage ETF in the US right now. So they're essentially the same product, same risk, just different market. And of course, we are in Singapore, SGX doesn't have all of these products. But if you have access to the US market through IBKR, Tiger Brokers, Moomoo, etc., you are really just a few taps away. So guys, please really be careful of what you are investing. Okay, so always do your own research. And in fact, just to share with you, Korean regulators have now frozen new single stock leverage ETFs and triple margin requirements. They have closed the stable door after the horse has bolted. The people who lost 70%, they can't wait for these regulations to kick in because they're so angry, right? Also, SK Hynix just signed a $915 billion deal with Nvidia. The company itself is doing extraordinary things. The AI chip story, it's real, it's growing. So these investors who lost 70% weren't necessarily wrong about the company. They were just wrong about how they invested in it. The product, the concentration, and the position sizing. So just bear in mind that being right about the trend doesn't protect you if your leverage, your concentration, and your purchase timing are wrong. I think it's really baffling, right? I was just walking around Seoul while this was all happening, and coming back when I read about it, it was really like a real reminder of how and why you invest matters as much as you invest in. Of course, I'm not saying I'm a perfect investor. I'm still figuring out my own investment approach. I don't have all the answers. And guys, this is not financial advice to buy into certain stocks. Please always do your own research. But stories like this are exactly why I think it's worth having these conversations. Have you guys ever been tempted by a leverage product or started using it or felt FOMO during a market rally? Because personally, I have not done any leverage. So drop it all in the comments. I read all of them. I hope you enjoyed my video. This is That Financial Goal. I'm a corporate banking finance professional with over 15 years of experience. So if you found this video useful, do remember to hit the like, share, and subscribe button, and I hope to see you guys in the next.